Hi everyone, it's Sean Lee from Unwavering Capital. Today I would like to pitch Long DaVita, a duopoly US dialysis service provider. This is a company that I have monitored since 2020 and I have generated 51% alpha since my initiation report on November 1st, 2023 because my contrarian thesis has played out. The fact that DaVita generates 89% of its revenue in the US and is providing life-threatening services, DaVita is a good safe haven during the tariff war uncertainties, weakening US dollar, and expected recession. Furthermore, the company has brought 54% of its shares since 2017 and commands 52% ROE and 34% market share in duopoly dialysis market with the white moat. With 17% upside potential and a 1.8 risk-reward ratio, DaVita is an ideal investment. To talk about the industry and company overview, DaVita dominates the duopoly US dialysis market. DaVita and Fresenius Medical Care FMS have 35% and 34% market shares, respectively, based on number of dialysis facilities. While the distant third and fourth players, US Renal Care and Innovative Renal Care, used to be known as American Renal Associates, have 7% and 3%, respectively. DaVita and FMS both have great bargaining power with insurance and pharmaceutical companies and 45 plus years of valuable patient data. But since FMS has a thinner margin by also having a capital intensive dialysis machine business and generates more revenue outside the US, DaVita is the better vehicle to play the US dialysis market. To talk about the business segments, while the US dialysis business contributes 89% and 107% of DaVita's revenue and operating margin, respectively, the IKC, the integrated kidney care business, generates 4% and negative 2% of DaVita's revenue and operating profit. IKC, also known as the value-based care business, is expected to break even operating income by 2026. International operation constitutes 7% and 3% of DaVita's revenue and EBIT. With 509 outpatient dialysis centers located in 13 countries outside of the United States, the international business will also add to DaVita's operating profit as their operating margin will resemble to that of the US operation. Although the GLP-1s may be a challenge to midterm patient volumes with potential slower progression of CKD to ESRD, it will likely be a net tailwind to long-term patient volumes due to reduced mortality associated with the drugs. This has been my contrarian thesis since my DaVita initiation report on November 2023, and I'm seeing more clinical trial data and experts validating my argument. For instance, the Swedish heart failure registry study conducted in March 2025 found that GLP-1 treatment was associated with a 48% reduction in cardiovascular mortality. FMS's former general manager also said during my primary research on May 3rd, 2025, that if you look at the data, there's a huge decrease in the mortality of the CKD patients, which could mean, yes, there's a slowing of progression, but it could mean a larger bolus of patients eventually making their way to ESRD. The only reason why we haven't seen a noticeable positive impact from GLP-1s yet is because it's a long-term trend and due to a big hangover effect from COVID from the huge impact of mortality. I expect 3% annualized patient growth in my base scenario during the next 10 years. My second thesis is that the market is overlooking the possibility of DaVita acquiring smaller dialysis providers. Fully cognizant of lower CMS reimbursement rates and rising cost of labor, the market is penalizing DaVita stock for limited margin expansion opportunities. But what they're failing to price in is the tailwind associated with these major headwinds. Structural market challenges hurt smaller dialysis organizations more than they do national operatings like DaVita, as SDOs have lower operating leverage, lower operational efficiency, and inferior cost structure. This dynamic begets an increasing number of SDOs that are struggling to remain profitable, creating acquisition opportunities for DaVita. Bears argue that regulators won't approve DaVita's SDO M&As on antitrust measures. But unless the CMS dramatically increases its Medicare reimbursement rates to cover rising costs, or nationalize bankrupt SDOs, the government won't have any other choice but to approve the consolidation. Since SDOs have a 21% US dialysis market share, DaVita has a long runway for acquisition growth. The first key risk is if the flu season persists and the mortality rate remains high, treatment volume growth may be negative. Although the market was expecting excess mortality to wane off post-COVID eventually, the death rate remains stubbornly high. DaVita management speculated it could be a longer than expected flu season. While it's assuring that the flu activity has recently been decreasing nationwide for several weeks, the weekly hospitalization rate has dropped to 0.5 per 100,000 people, down from a peak of 13.6 per 100,000 earlier in the season. Certain areas such as Houston, where DaVita has a strong presence in, have reported significant surges in flu cases compared to the previous year. Thus, I have projected 2025 year-over-year treatment volume growth to be negative 0.4% in my bear scenario to reflect the possibility that the flu season will last longer than anticipated. My second key risk is wage pressure will continue due to COVID-led labor shortage and higher turnover. There were a lot of healthcare personnel who left their professions due to burnout during the pandemic. And my expert calls confirm that dialysis providers are having a very hard time attracting nurses and patient care techs for employment. And thus, they are having to raise their salaries significantly in order to retain their talent. That said, this negative trend has been well telegraphed by DaVita management since COVID. They forecast the year-over-year growth rate of patient care costs per treatment will be higher than that of revenue per treatment. Thus, I believe the market has fully priced in this risk. In addition, the fact that DaVita remains confident with its long-term target for operating growth of 3% to 3.7%, 2025 guidance is 5.24%, with other cost-saving measures such as closing down unprofitable centers, assuages my concern that DaVita's structural wage inflation. I have projected 2025 patient care costs per treatment to rise between 5.8% and 7.1% year over year, a wider range than what the management has guided, which is 6% to 8.7%, to capture a full spectrum of possible scenarios given the highly unpredictable nature of the current inflation rate. Moving on to the valuation. DaVita should be valued by cash flow per share instead of EPS. First, DaVita has a reasonably high depreciation and amortization from owning and operating dialysis centers, which reduces accounting earnings but doesn't reflect actual cash leaving the business. Secondly, for leveraged companies like DaVita, cash flow measures are more informative than EPS because interest payments and refinancing risks are cash-based and not reflected fully in EPS. I applied a 7 times forward cash flow per share multiple in my base scenario to obtain my price target. This is a conservative estimate because it's only a 6% premium versus its 5-year historical average multiple of 6.6 times and 3% premium versus its current trading multiple of 6.8 times. I believe the market will grant DaVita this premium in the next year once it generates strong earnings revisions. DaVita has many levers to do so, such as the higher than expected interest reimbursement for new oral phosphate binders, better visibility into the elevated mortality rate, treatment volume recovery, and lower than expected treatment costs, etc. If you want access to my fully integrated DaVita financial models to sensitize key assumptions, please visit my Substack.